Welcome to this recorded session. So, in this recorded session, we are going to be discussing the FM September-December 2023 paper, specifically the question one, which is Pulrough Co. Okay, is a question from investment appraisal. All right, so let's start. Okay, let's start by going through the question, reading the question, and understanding the case. Okay, let's read. This scenario relates to five requirements. Pulrough produces household electrical goods for its home country market and for markets in neighboring countries. Pulrough is planning to make a major investment in new production facilities in order to produce an upgraded model of its cooker. Pulro's finance director has assigned probabilities to a number of possible sales volume of this new model. So, this is a new investment appraisal project. But with regards to this project, we are not 100% certain. We don't know with certainty. Okay, we are not 100% sure with regards to the what will be the sales. That's why we have calculated probabilities. So this is a situation of risk and uncertainty where we do not know the outcome. There are multiple possible outcomes. All right. He has calculated the annual expected values for sales for the 4-year time period over which the investment will be assessed. So the sales volume figures which are given over here are not actual sales volume figures, these are expected values. However, after a number of years of strong economic growth, Pulro's home country and its neighbors appear likely to enter a period of a recession. Okay. So Pulro's wherever Pulro is doing the business, that areas for those countries are going to go into a recession. Okay. Therefore, what is the outcome? So that meaning that consumers may be less willing to spend money on new kitchen goods. Okay. So now this raises the question that okay, maybe these figures which they have given here, the expected values which they have given here might be optimistic values. Maybe he has calculated based on the past performance. The sales volume in a period of strong economic growth and the sales volume in a period of a recession is very different. So the figures which are calculated over here might now you are calculating, you are forecasting based on what happened in the past. But in this scenario, what happened in the past is not a proper indication of the future. Why? Economic condition in the past was different, economic condition in the future is going to be different, cannot be compared. Right? Important points, note down. You should get this understanding. When reading the questions, these understandings automatically you should get in your head. Okay. Next. The initial investment would be 39 billion. The finance director has assumed that there will be zero realizable value. Scrap value would be zero at the end of 4 years. Working capital can be ignored. Expected volumes are given. Next, the expected contribution from the upgraded cooker throughout the 4 years is $200 per cooker. This will not be affected by the rate of inflation. Okay, fine. Incremental fixed costs, excluding depreciation, are expected to be 2.5 billion in year one. They will increase by the rate of inflation in each of the years 2 to okay. So they have given here the fixed cost. They have given the incremental fixed cost in year one terms, not in today's terms, not in year zero's terms. It's given in year one's terms. Therefore, when you are inputting that into your NPV format, you don't have to inflate it. Only for year 2, 3, and 4, we have to calculate the inflation. Okay, so that's given, inflation rate is given. Pulrough pays corporation tax of 25% per year, 1 year in arrears. No tax deferral depreciation is available on the investment expenditure. Pulrow currently uses, sorry, 11% as the after-tax discount rate to appraise investments like this. One of the other directors has commented that he thinks that the level of contribution that the finance director has assumed is too high. Okay, so another director is raising the question, okay, finance director, you have told us that the but you have told us that the contribution is going to be $200. We don't believe this. Maybe these very optimistic. These are high figure. You are being too optimistic. No, it's not possible. That's what the other directors are commenting. He also wonders that with the economic uncertainty, the cost of capital will be higher. Okay. The finance director has said that he will prepare sensitivity calculations showing in relative terms the level of change in contribution and the discount rate that would produce a nil net present value. He will assume that the contribution will be lower by the same percentage each. Another director has stated that she has heard that probability analysis can be helpful in decision making and not the if this will be the same as sensitivity analysis that the finance director is going to prepare. So when reading this point, we can understand, okay, definitely there's going to be a question where they are going to ask the difference between sensitivity analysis and probability analysis. So when reading the scenario, we've understood what we are going to test. Now all the information is in our head. Now we can start with, the workings or the calculations, whatever we can attempt the questions. Look at the first question. What are they saying? Discuss. What is discuss? Talk about it, explain, discuss. The difference between risk and uncertainty. What is the difference between risk and uncertainty in the context of investment decisions? So when we are talking about investment appraisal, with regards to investment appraisal, what is exactly the difference between this risk and uncertainty? That is what they are asking. So let's put down to main topics. We're going to talk about risks first, and then we're going to talk about uncertainty. The spelling of that was wrong. We just copy paste it from here. So when they ask you the difference of something, initially you are supposed to start with saying that okay, we are going to talk about what is risk. We're going to talk about okay, what the hell is risk. Okay. So with regards to risks, okay, so we're going to say risk. How shall we say this? Okay, we need the requirement again. Discuss the difference between risk and uncertainty in the context of investment decisions. 3 marks. Okay. Risk occurs, or we can say risk is the scenario, is the situation where we know the possible outcomes and the associated probabilities. There, risk is quantifiable. Uncertainty is the situation where we know the possible outcomes, but not the probabilities. Therefore, uncertainty is not quantifiable. So that is basically the definition. Risk is quantifiable. We will know, okay, what is the probability of the outcome of the risk. Okay, let's say for with regards to an investment appraisal projects, if you continue with the project in the future, maybe the economy will be good, economy will be normal, or economy will be weak. So if we know, okay, what is the probability that the economy will be normal? Probability is 50%. If we know what is the probability that the economy will be strong, that is 30%. If we know what is the probability that the economy will be weak, that is 20%. So when we know these particular probabilities, that is what we call as risk, correct? So that's the basic definition. So over there already, the main difference they can identify, the examiner can identify, okay, risk is quantifiable, uncertainty is not quantifiable. Okay. So we can say the probabilities. Okay, so the probabilities, those percentages are calculated based on past experiences and events. Okay. So the probabilities now. How are you going to predict the future based on the past? Okay. So when you have, if you are running a business, you are running the business for the past 10 years. Okay. So you are very familiar with the economic environment of the country which you are operating in. So when you have that level of understanding, that level of experience with regards to the past, you can use that to, predict the future. So you can calculate the probabilities. Okay. But uncertainty occurs when the business is attempting something new and therefore does not have any past experiences to determine probabilities. Okay. It's a unknown. Okay. So it's a 3 marks question. It's a 3 marks question. Okay. So you don't have to write a lot. Simply if the difference is properly given, that is more than enough. So that is that for this requirement. 3 marks in the back. Moving on. Okay. So requirement B, calculate the nominal net present value of the investment project and comment on its financial sector PDT. So it's an investment appraisal question. It's pretty straightforward. We are going to calculate the NPV. So to calculate the NPV, it's a 4-year project. So we're going to start with year 0, year 1, year 2, year 3, and year 4. We're going to start off with the investment value. How much has to be invested? Investment cost will be 39 million. Let us take all of the figures in thousand. All of the figures are in thousands. So that would be 39,000 negative. Okay, be very careful. Positive, negative, cash inflow, cash outflow. All right. So next, what can we take? Okay. So now in this scenario, we can take the sales. Okay, we can take the sales value. We know what is the expected volume of sales, and we know what is the what selling price. Yes, selling price is given. No, selling price is not given. So we are going to be taking what? The contribution. We are going to be taking the contribution. So each and every year, your contribution is going to be $200, and it will not be impacted or it will not be affected by the what? It's not going to be affected by the inflation. So 600, sorry, 200 into 60, 200 into 150, 200 into 140, 200 into 8. These are your contribution figures. Next, you can have the fixed. So fixed cost. Year one, what is the fixed cost? 2.5 million. So that is not requiring any. We don't have to make the inflation adjustment for year one. Why? Because they have already given in year one term. So inflation is already included inside that 2.5 million. From year two onwards, we will inflate it. From year two onwards, we will inflate it. So here two, what is the inflation rate into 1.06? Okay. Now for year three, when we are inflating the fixed cost, when we are inflating the fixed cost of year three, be very careful, guys. Now, certain students, what will they do? They will take year one's figure 2,500 into 1 point. What is the rate of inflation? 4%. So 1.04 to the power of 2. Is this correct? Will this give you the right answer? No, this will not give you the right answer. What is the reason for that? When you are doing this calculation, when you are putting it into 1.04 to the power of 2, what are you doing? See, you are inflating that 2,500 for 2 years. You're inflating it for 2 years, correct? But this formula is assuming that the inflation for both of the years is 0.2. That is the problem. That's not correct. No. For year two, inflation is 6%. So what should happen? From year one to year two, you should inflate it by 6%. Year two to year three, it should be inflated by 4%. So what should you do? You do, you take the year two figure. We will inflate directly the year two figure by 6%. Sorry, 4%. Uh-huh. So what is the fixed cost? 2756. Simple as that. So same explanation for year four. So we take the year three figure, inflate it by 328. So what is your operating profit? It's not operating profit, it's operating cash flows. Okay, try operating cash flows. Next, you have your tax at the rate of 25. So tax is paid 1 year in arrears. Okay, so year one's tax will be paid in year two's tax will be paid in year three. Year three's tax will be paid in year four. Year four's tax will be paid in year five. So even though the fee handle works, make sure to always recheck whether you have it correctly. You know, what certain times there might be problems with the software. So make sure that you are rechecking, right? So next, you have the net cash flows. Are there any other adjustments to be made? No adjustments. There is no tax allowable depreciation. There is no working capital adjustment. None of these adjustments are there. So simply we don't have to do that. So what are the net cash flows? Net cash flows. Now what do we need? NPV. What is the cost of capital? 11%. Okay, so we are going to calculate equals NPV for the brackets. 11%, comma, year 1 to year 5 plus year 3. What is the NPV? 5,847 positive. So what should we do? What is the recommendation? Since the NPV is positive, 5,847 Pulrough should accept. Simple as that. Simple as that. NPV positive accept. 5 marks. Done. Easy. Easy. Fine. Requirement 2. Calculate the sensitivity of the project's net present value to a change in the level of contribution per unit and calculate the sensitivity of the project's net present value to a change in the discount rate. All right. So in order to calculate the sensitivity, what do we need sensitivity? The present value NPV divided by the present value of the variable. NPV divided by the present value of the variable. Okay. So here, what is the variable? They asked to calculate the sensitivity of the level of contribution. So the variable is the contribution. So we need the present value of the contribution. Here one, here two, here three. Yeah. Contribution. We can just copy these figures. Why is it not working? Copy. Fixed. All right, there we go. Fixed. So with regards to calculation of the contribution, we need to calculate the present value. Okay, so if we want to calculate the present value, we can use the present value formula. But with regards to sensitivity, it's better if you go with the what? It's better if you go with the discount rate. So for 11%, what are the discount rates? Is the contribution. Discounting factor 0.901. 0.81, 0.731, 0.65. Right. What are the present values? These are your present values. So what is the total present value? Total present value. 1184. So sensitivity would be NPV divided by the present value of the variable. How much is that? 8.8. What does that mean? If your contribution changes, if your contribution drops by 8.84%, the NPV will become zero. You will change your decision. Okay. Next, how do you calculate the sensitivity of the discount rate? You need to calculate the IRR. So to calculate the IRR, let's just copy paste this once again. Copy and paste. Then from this one we need to calculate the IRR. So simply we can use the IRR formula. So equals IRR, open the brackets, here 0 to here. What is your IRR? 18.4%. That is your IRR. So in order for your NPV to become zero, in order for your NPV to become zero, from 11%, your discount rate should become 18.4%. So what is the what do you call, what is the sensitivity? By how much of a percentage should it change? Sensitivity. So from 18.4%, so 0.184 minus 0.11 1, 0.1. Okay, the change. How much it should change by the change over the prop? It will give you the sensitivity. What the sensitivity? 67.27%. If your discount rate increases by 67.27%, your NP will become zero. Simple as that, right? Next. That's it. No, 3 marks, 3 marks, easy. We've gotten that piece of cake. Moving on to the final requirement, 6 marks. Wow, typing. Let's see what they want. Compare and contrast. Compare and contrast. Compare and contrast. What is this compare and contrast? Simply they are asking you get the differences. Explain it. Explain that advantages, disadvantages. What is the difference? With regards to okay, making the decision. How do you make the decision using sensitivity analysis? How do you make the decision using probability analysis? Etc. Okay, fine. So first, let's look at let's give a general description of sensitivity analysis. Okay. So sensitivity analysis looks at sensitivity analysis looks at how much a certain variable has to change in order for us to reverse our position. Yes or no? Yes, that is what sensitivity analysis is calculating. On the other hand, probability analysis, what does it do? Probability analysis looks at the probability of, or we can say, because we can say rather than probability, we'll use the term likely. Okay, maybe if you put probabilities in correct, it's correct. But because it's called probability analysis, better to put likelihood of a particular outcome occurring. So now we are going to look at, okay, with regards to decision making, what are the differences between how to make the decision using sensitivity analysis, how to make a decision using probability analysis decision making. Sensitivity analysis will not provide us or will not give a clear indication whether to proceed with the particular project or not, but rather it would help to identify critical variables in the project so that we can focus on these variables. Critical within brackets, we can say sensitive and sensitivity, and not and try to keep them stable. Right? So that's what sensitivity analysis will do. Okay. Probability analysis, on the other hand, would be to calculate the expected value of a change. Probability analysis will be used to calculate the expected value. And we would choose the project with the highest expected value. Okay. But probability analysis is not taking account the risk appetite the managers would take. That's the first factor which we are going to talk about. Okay. Next, the likelihood of the outcomes. Okay. So, will sensitivity analysis give you the likelihood of possible outcome? Will it give you, okay, this is the probability or this, the chance of, the selling price reducing is 20%? No. So, we can say sensitivity analysis would not provide the likelihood of a particular outcome of the region. So it does not do that. But probability analysis provide would provide the like of particular. The final point we're going to talk about the number of variables. Number of variables. So sensitivity analysis, sensitivity analysis can only look at one variable at a time. Therefore, we cannot calculate the impact of multiple variables in and easy time. But probability analysis, on the other hand, can allow multiple variables to change through the combination of probabilities. So that's that compare and contrast the two. Okay. Easy, not that difficult. All right. So that's that for this question. Okay. So easy, simple, 20 marks, guys. Very easy to get it. So I hope everything is clear. With that, that's that for this recording. See you all in the next one.